Okay, continuing on in Chapter 4, we're going to look at another example of an intercompany transaction when between parties they sell land or depreciable assets. Biggest difference between land and the other depreciable assets is the depreciation factor, which we'll see in this example. So using exercise 5 from the text, Wavemaster is the parent, owning 80%, so it's an 80-20 ownership. Saner is the sub, and Saner had land in a building that they constructed, they turned around and sold to the parent. So if we were doing income distribution schedules like we did in exercise 1, adjustments for these worksheet entries would again go on the sub's books because the sub is the seller. But remember, that doesn't have to always be the case. Now Wavemaster, the land cost them $50, they turned around and sold it for $100. So right now on the parent's books, the land is overstated by $50,000, and that $50,000 has to come out of land and out of the gain because it's not a gain based on a transaction with an outside party. So we're going to eliminate that on the worksheet by debiting the gain and crediting land. The building also had a profit factor when it was sold to the parent of $150, and we're going to eliminate the same excess in the asset as well as the gain, just like we did for the land. For 2011, that's all there is to it because you see that the transaction happened at the very end of the year. However, when we get to 2013 now, all of 2012 has elapsed and all of 2013, so there's been some depreciation that happened on the building and we need to adjust for that. Starting off though with the land is still on the books at an overstated value from the parent, so we need to eliminate that. But the gain is obviously no longer on the books because it's been closed to retained earnings over that period. So we adjust for where the gain was to the retained earnings where it would have been closed, and adjusted in this case for the 80-20 ownership, 80% of that gain belonging to the parent, 20% belonging to the NCI. For the building, it's also still on the books, overstated on the parent's general ledger, so we need to eliminate that. Now that building adjustment though is going to be eventually depreciated over the life of the asset because it doesn't have indefinite value like land. And another way of looking at this is that at that higher value that the parents recorded on their general ledger, their depreciation expense is actually too high, so we need to adjust the depreciation expense. So we're going to take that $150 and depreciate it over the 20 years that's given in the book, and each year we're going to adjust depreciation expense and accumulate it for $7,500. Well, this F2 entry would have been done in 2012, and remember the worksheet doesn't get closed to a ledger, so we have to accumulate what would have happened in prior periods. So the $7,500 I'm putting there relates to the prior period for 2012. We'd continue to accumulate depending on how many years have elapsed, and the difference is that remaining gain that has not been written off to depreciation or not been adjusted through depreciation. So it's going to be the difference between our gain, total gain, and what has been depreciated, and then we need to take that by the ownership percentage because again, since the sub is the seller, it has to be split between the parent and the NCI. Keep in mind, if the parent was the seller, then we would not have these adjustments. It would be strictly to the retained earnings of the parent. We wouldn't have to adjust it because no one else would have a right to it. Let me finish up the entry here, making the adjustment for the subs 20, and that should take care of our entries that they now balance. These would be incorporated into the worksheet, carried across for the line items that they match up to, just like any of the other items.